In this video, we would like to try and explain the financial market reaction since the beginning of the U.S.-Israel attack on Iran and the subsequent retaliation by the Iranians. The oil price initially spiked higher after the bombing began on February 28, 2026. Iran is a major Middle Eastern oil producer, and the Strait of Hormuz moves approximately 20% of the world's oil daily. The Iranians responded and attacked several of the Gulf states, Bahrain, Qatar, the United Arab Emirates, Kuwait, and Saudi Arabia, damaging some of their oil-producing facilities, which contributed to the market's fear of even larger amount of production going offline for a longer period of time. With oil jumping over $100 a barrel initially, up 50% from when the war started, the bond markets in the Western world reacted. Interest rates spiked on both the short and the longer-term government bonds of the European countries, Canada, and the U.S. This reaction was due to the expected higher inflation that will occur because of the now constrained oil market supply and the higher prices. The war also diminishes the market's expectation that many had that these countries were going to be soon able to lower interest rates to help their economies. Higher inflation and higher interest rates scared stock markets, and they sold off under this new immediate scenario. Adding to the stock market sell-off at this time are the growing problems in the private credit and private equity markets. This arena of investing, often referred to as the shadow banking system, has accumulated a lot of investor money in recent years looking for higher and more stable returns than what bonds or equities normally offer. Investors have been getting worried as to the safety of their investments, having increasingly been pulling money out of the sector, and just recently many private equity credit funds have now gated their doors by restricting redemptions. This means investors can't get their money back at a time when confidence in the economy and the political system is waning. So this does not help economic growth going forward. In summary, the war has resulted in higher bond yields, lower equity prices, and lowered risk tolerance in the financial markets. The primary export of the Gulf countries we mentioned earlier is oil. With Iranian hits on oil facilities, investors in these countries are rightfully very nervous. They have begun selling their local currencies, which are pegged to the US dollar, in order to convert their money into the US dollar. These investors are also selling gold, as it is one of the most liquid and easiest assets to sell when one needs large amounts of US dollars. As well, these Gulf countries are desperate to maintain their currency peg with the US dollar and may also be selling large amounts of their gold holdings for this purpose. We could possibly see capital controls soon in these countries if this process continues. Gold and U.S. Treasuries are currently being punished by this liquidity-driven selling, which has helped to take gold down currently around 20% from its recent highs of $5,586 U.S. The financial markets have reacted to the initiation of the war. Now we will watch and see how the markets price in potentially how long it takes for this war to come to fruition and how much damage will ultimately be done. This is impossible to gauge and of course helps explain why financial markets are so volatile currently. With the recent drops in gold and stocks, it's quite possible we are closer to the end than at the beginning of this narrative. But there's no real way of knowing. This will be very testing on investors' nerves and could have them questioning their confidence in their investment strategy. This is normal during periods of extreme uncertainty. We believe that President Trump will not want this war to go on much longer, as it has had the potential to really hurt the U.S. economy. The longer this goes on, the more problems the U.S. faces and the less leverage it will have in the global sphere. One thing that could come out of this war, and that may be a byproduct of it, is the financial reset. Countries could come to new agreements featuring new trade relationships with one another. In fact, one piece of information we've learned through this crisis is that Iran has been doing oil for yuan sales with China for a lot longer than anyone thought, and Saudi Arabia has also been moving more of its oil sales into yuan from US dollars. If we don't see a peace plan agreement soon between the warring parties, we believe that we will see a central bank and government intervention by the U.S. in order to help stabilize the global financial markets. The U.S. will, much like 2008, cut interest rates and do massive quantitative easing to make money cheap and abundant. The U.S. economy is very highly levered, and it cannot withstand much higher interest rates nor much lower equity prices at this current stage without it inflicting real damage. This is what central banks and governments do in crises and will always do in crises. They cut interest rates and print money. We believe that this crisis will play out much like 2008-2009 subprime mortgage crisis. Here we see going into the subprime mortgage meltdown, oil prices ran up to $145 US a barrel, which helped to slow the economy and help accelerate the financial crisis. The price of gold dropped a little over 20% from 900 to 700 approximately during this period as equities, especially financial stocks and corporate debt, took a hit. In fact, the whole financial system was at risk given the large losses that the banks had on their balance sheets. When the quantitative easing was finally announced in 2009 after multiple interest rate cuts, the price of gold and equities soared back, and by 2011, the price of gold would be reaching a high of over $1,900 US an ounce in just under 2.5 years. We believe this situation is quite possible once again as the markets see that the central banks and the U.S. government are forced to come back to the rescue of the global economy and the financial markets. Currently, we had rebalanced the gold and silver multiple times since the beginning of 2026 to lock in gains when they were rallying. The permanent portfolio design that we use ensures that we do not have too much capital in any one sector and that we are consistently rebalancing when we have gains. The drop in the gold and silver price we are experiencing right now, we believe, is temporary. Despite this drop currently, the longer the war in the Middle East goes on, the more favorable it is for gold and silver prices. Wars are always very expensive, and countries are forced in one way or another to devalue their currencies and debt during or following a war as a result. So patience now is very important. We are currently up a little over 2% for 2026 year to date, but are down from the close to 8% peak we had set at the end of February. Again, our goal is to preserve capital, and we believe our model will do this through all of this uncertainty. We are nicely positioned for a recovery when it ultimately begins.